What if I told you the biggest financial crash in modern history wasn't caused by a war, a terrorist attack, or even a natural disaster? What if the trigger was something so ordinary, a mortgage payment, that it exposed a $1.20 quadrillion web of greed so fragile, it nearly erased the global economy in 72 hours? And here's the part no one wants to admit, the same system that almost ended the world in 2008 is bigger today. But how did we get here? Who really pulled the strings? And why does almost no one talk about the one document that could have stopped it all? Stick with me. Because by the end, you'll see 2008 not as history, but as a warning. Let's rewind. To understand the crash, we have to go back, not to 2008, but to the 1990s. A time when a single idea took root and grew into a monster. But first, a question: what do you think caused the 2008 crisis? Subprime loans? Greedy bankers? Government failure? Write your guess in the comments. Because soon, I'll show you the real origin story, and it starts with a law no one remembers. Let's start in 1999. President Bill Clinton signs the Gramm-Leach-Bliley Act. This law repealed Glass-Steagall, a Depression-era rule that kept commercial banks, where everyday people keep checking accounts, separate from investment banks, the high-stakes gambling side of Wall Street. With one signature, banks could now use ordinary deposits to fund risky bets. That was the first domino. Next, the Federal Reserve. From 2001 to 2004, Chairman Alan Greenspan cut interest rates to 1%, the lowest in decades. Money became dirt cheap. Banks could borrow at 1% and lend at 6% or more. Easy profit. But safe borrowers ran out fast. So banks turned to subprime borrowers, people with bad credit, no income verification, no assets. By 2006, 40% of all U.S. mortgages were subprime or Alt-A, totaling $1.3 trillion in risky loans. Banks didn't worry. They had a new invention, the collateralized debt obligation, or CDO. Here's how it worked: bundle 10,000 risky mortgages, slice them into layers, safe, medium, junk, pay rating agencies like Moody's and S&P to label the top slices, AAA, then sell them to pension funds, European banks, even Iceland. Profit was massive. Risk was hidden. But one person saw the danger early. In 1998, Brooks Laybourne, head of the Commodity Futures Trading Commission, warned about unregulated derivatives, financial contracts tied to these CDOs. She called them weapons of mass destruction. Her opponents? Alan Greenspan, Treasury Secretary Robert Rubin, and Deputy Treasury Larry Summers. They said the market would self-regulate. Bourne was forced out. Derivatives stayed unregulated. By 2003, America was drunk on easy money. Home prices rose 80% in 5 years. The lie spread: housing never goes down. Banks pushed liar loans, interest-only mortgages, and pick-a-payment loans where borrowers could pay less than interest and owe more each month.